Welcome to Get Rich Education. I'm your host, Keith Weinhold. Cash flow can be one of the more predictable of the up to 5 ways that real estate pays you, but we're focused on where you typically achieve the most financial benefit with appreciation today, and the housing market is just booming. Homebuilder confidence is at an all-time high. I'll tell you why that matters. Then learn about why real estate in itself is not an asset and what it takes to make it one today on Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to 4plexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Richmond, Virginia to Richland, Washington, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, and the housing market is just booming by nearly any measure. 6 months of inventory is that dividing line, the teeter-totter fulcrum of where a balanced market lies. Well, nationally, only 2.7 months of housing inventory exists, which feels like nothing. Now, I have one property manager in Florida that manages my properties and hundreds of others. He told me yesterday that in his 14 years, this is the first time he's had 100% occupancy for any extended period of time. So the housing market has a lot of momentum. Even though we're in macroeconomic bad times, well, just imagine how much better it could be in good times. Let's try to be forward-looking here. Now, no one's got a crystal ball, but in real estate, I'll tell you one thing that is close to a crystal ball. That could very well be the Homebuilder Confidence Index, and that index is now at its highest point in 35 years. This confidence is not just anecdotal. This tracks the National Association of Home Builders and the Wells Fargo Housing Market Index. But that Home Builder Index, that was only put in place 35 years ago. So therefore, it's the highest home builder confidence in the all-time history of that index. The index rose 5 points to a score of 90, and it basically gauges home builder perceptions of current single-family home sales and sales expectations for the coming 6 months out into mid-2021. So this is a forward-looking indicator, this Home Builder Confidence Index. It basically says that home builders feel like they can quickly sell any home that they build. There's essentially no fear that they'll build it and no one will come to buy it. The chief economist at the National Association of Home Builders, he said that higher construction costs and the specter of rising interest rates due to increased coronavirus optimism, like with the vaccine, that could keep emerging as a story. Basically, to help us mark this episode, if you're listening to this 5 years from now, is that right now, investors are juggling this horrible short-term news with surging virus cases, but great long-term news, that being the new reality of effective vaccines. When we talk about shorter-term forecasting in the housing market, listen to this recent CNBC interview about the climb in home prices with Evercore analyst Stephen Kim. It is about 90 seconds in length.
Do you see signs of froth out there at all?
Well, I certainly see signs that housing prices are rising very rapidly, and I know that that's caused a lot of concern for some of the bears out there who are thinking that this has gone too far, too fast. But no, I actually don't think so. And I think, in fact, quite the contrary. We're at the early stages of really a monumental rise in home prices, and that we think it's going to be tremendous for the builders, particularly for their margins. And I think we're actually pretty much on the early end of this.
Wow. Wait, so let's talk about this for a second. You think we're on the early end of a monumental rise in home prices? I mean, that people are already starting to get a little bit of sticker shock.
Well, sure. I think that there's a little bit of a fundamental misunderstanding about what's going on. Like, for example, I've fielded a lot of emails from clients this week suggesting that the builders have pushed prices too much without recognizing the fact that I think that builders are actually price takers. The price of homes is set in the existing market, which outnumber new homes by about 5-1. And if you look in the existing home market, the reason why prices are going up is because demand's good, sure, but the real thing is that supply is incredibly constrained. You have never seen a level of tightness in the existing home market of homes for sale as you see today. And when there's a shortage, well, guess what? Nothing sells like a shortage and home prices go up. Meanwhile, on the new side, the builders also have construction constraints, labor constraints, land constraints, and things like that. So really, when you have good demand and you have just incredibly tight supply, home prices go up.
Yeah, it's the same thing I've been focused on for a long time, that constrained supply. You know something? Interest rates direction, that actually has little to do with housing prices. Yes, it's a factor. It's just not as big of a factor as people think. A couple of years ago, in 2018, remember the Fed hiked interest rates and mortgage rates went up too, but home prices kept rising despite the rising rate environment, and now they're rising in a lowering rate environment. And then remember further back in 2008, it wasn't about interest rates going up or down at all back then. Housing prices went down then because you couldn't get a loan. No loan, that meant that demand dried up. Well, the Fed learned their lesson and now they step in during a crisis to ensure that liquidity is there for consumers and for borrowers. We're going to return to the home price appreciation discussion in just a moment, but I want you to realize something. In itself, real estate is not an asset. It's not an asset. It needs to be maintained and it wears out. Rather, it is real estate derivatives that are the assets, whether that be your mortgage or your lease. Real estate alone is a liability. Your mortgage and your lease, that's what enables you to control the investment and the income stream. A piece of real estate just sitting there can erode in the elements. It's a liability. So you add a mortgage, you add a lease, you add a good property manager, and only now do you have the asset. Landlords are raising rent in the suburbs. TheRealDeal.com just reported on this, and Realtor.com made a similar report. Now, it's not just the individual investor like you that's picked up on the single-family rental home trend in the suburbs. It's also these big institutional investment companies that have gotten in, like Invitation Homes. Realtor.com was just reporting that what they call the race for space is pushing up suburban rents. And they don't mean the race for space like outer space. They're talking about getting some elbow room in the suburbs. So these big companies that own tons of single-family rental homes, they are raising rates now at the fastest rate since they emerged from last decade's foreclosure crisis, capitalizing on this rush for suburban housing. Tenants are accepting rent increases rather than moving out. New renters are hunting for home offices and outdoor space, and they are paying up to move in. Asking rents for available properties owned by these big home rental firms jumped 7.5% in October. That is according to real estate analytics firm Green Street. Mom and pop operators and individual investors, they own way more of the country's 16 million rental houses than these big companies do. Well, mom and pops and individuals, they're raising rents too, but just not as aggressively as America's mega landlords. But when the mega landlords raise it, you should be able to follow along and have the ability to raise it too, because the mega landlords help set the market. The mega landlords, they're using computer programs to match rents with demand. And remember, those mega landlords, they do have their own investors to have to please. Now, back in September, single-family rents climbed an average of 3.8% from a year earlier across 63 markets, regardless of who the owner was. That's according to John Burns Real Estate Consulting. And there was not one market that declined. That is astounding. Increases of over 5% came in these corporate landlord strongholds like Atlanta and Phoenix, but also in Middle America around Memphis, Minneapolis, and Kansas City, as well as in some of the West Coast's less expensive inland markets like Sacramento, California, and Portland, Oregon. And yes, Portland is an inland market. To get away from the Realtor.com stuff for a moment, I just want to jump into and note that it is all remarkable that this is happening in a recession, and also that we do have an eviction moratorium in place until year end. Well, Realtor.com goes on to say that Wall Street is betting on rental homes long term. That's where they're placing their bet. Wealth managers, private equity firms, and other big investors, they have pumped billions of dollars into home rental operations this year so that they can add houses. These investors anticipate a wave of high earning but debt-saddled millennials forming families and fleeing into the suburbs in search of good schools and granite countertops. Many are millennials that are drawing some pretty good salaries, but they're carrying so much student debt that buying a home is difficult even with these historically low mortgage rates, so then they rent. Builders have ramped up construction, but they aren't adding much at the low end of the market. In fact, today only 10% of new homes sell for under $200K. Well, that is all from what Realtor.com has to say. And this is really why I set up a website for you here like GREturnkey.com, where you can find some of those new construction and rehab rental homes for around $200,000 or less. See, the benefit about reporting single-family home rent increases with big institutional investors. See, these big investors, they have the ability to aggregate data because they have big sample sizes. So to get a bunch of individual investors like you or mom and pops to aggregate all of your rental figures together in a meaningful way, that is exceedingly difficult to do. Well, you know that from inception of this show in 2014, we've talked about really suburban real estate more than any other, and that is the real estate that's conducive to single-family homes, sometimes townhomes, and up to about duplexes, maybe fourplexes or so. So if you've been following along and following my plan and acting, hey, it is okay to pat yourself on the back, congratulate yourself. You have seen some nice appreciation and some strong demand. But what about getting more than 20 loans on these properties if you're married? Or trying to get more than 10 if you're single? How do those loan programs look today? Well, Ridge Lending Group President Shaylee Ridge will be back on the show with us soon to discuss that. And since Shaylee helps originate so many investment property loans nationwide every day, I often like to ask her what percent of appraisals are coming in high, what percent are coming in right on, and how many are coming in low. That'll be especially interesting in a strong appreciation environment like this, so I plan to ask her about that for you. Hey, just a reminder to join me and the provider live for our Tropical Tiny Homes webinar. That is tomorrow night, and it's such a dreamy thing to think about and talk about. There might still be time to sign up for the webinar. Get started at getricheducation.com/tinyhomes. I'm going to be there live. Let's talk more about home price appreciation. This week's guest owns a real estate company that's done more charitable giving to communities than just about anyone else that I can think of. He has now over 3,500 properties under management in Jacksonville, Florida. His company, JWB Real Estate Capital, they've been named one of Inc.'s fastest growing companies 8 times now. And the workplace that he's created, which I have been inside myself there at their main office in Jacksonville, is a 7-time winner of the Best Places to Work award. I'd like to give a big welcome back to one of the really good guys in real estate here to GRE. It's Greg Cohen.
Hey, Keith. Thanks for having me.
Greg, you've also been buying other commercial buildings in downtown Jacksonville seemingly every time I turn around. So do you just own all of Jacksonville by now or what?
It's been pretty funny. We have taken some moves to really make an impact in downtown Jacksonville, and you start to plan out these investments generally years in advance. And so we have purchased 4 buildings downtown in a relatively small cluster. Wouldn't you know that after planning for years in advance, we closed on all 4 of those properties within a 6-month period and 3 of those properties within a 3-week period. From a marketing blitz perspective and from some PR and some getting our name in the business journal quite often, it worked out well. Of course, you couldn't plan it like that, but we'll certainly take it.
We might soon rename that city as Cohenville at this rate. So, Greg, you know how I am known for talking about the 5 ways that real estate can pay you simultaneously. Oftentimes you have appreciation, cash flow, your return on amortization, that basket of tax benefits, and then finally that inflation profiting benefit. I know you and I would probably agree with you that investors often only pay attention to that net rental income, and they seem to ignore the other profit centers. Maybe it's because that net rental income seems like the most predictable of the 5. What do you think?
I absolutely agree with you. And then most of us lived through the Great Recession. And for those who were investing in real estate prior to the Great Recession, everybody thought that real estate always went up in value. Right. I mean, you didn't talk to anybody who said real estate went down in value. That was never the case. And then, after living through the Great Recession, and that's where I started to invest in rental properties. I bought my first 40 rental properties at the height of the market in 2006 and 2007. Flash forward to surviving and thriving and still owning those rental properties and adding more. We've now gotten to a place where everybody says, well, I can't count on home price appreciation. As investors, we tend to go too far in the other spectrum. And so the unfortunate thing is if you don't understand how to evaluate home price appreciation, along with the other profit centers that you talked about, you end up leaving a lot of money on the table and possibly making the wrong decision for your investment portfolio over the long run.
It is interesting comparing this current recession to the Great Recession, which one might characterize as about 2008 to 2010 or so. And you just can't liken the two that much. They're just seriously not the same thing, other than things outside the housing market like GDP contraction. I've talked before on the air a lot of times about how we're just in such a different place with regard to supply versus demand imbalance. We were oversupplied 12 years ago. We're substantially undersupplied now. Another thing a lot of people don't think about when it comes to appreciation is leading up to the Great Recession, we had unsustainable home price appreciation of 20% per year, 30% per year, even 40 or 50% per year in some markets like Las Vegas and Phoenix. So that just wasn't sustainable. And leading up to this crisis, we had a 4% national appreciation rate, very sustainable. And now we have the interest rates that are so low to helping support these greater prices and help lubricate this appreciation. So tell us more about why you think it's a mistake not focusing on appreciation and some of those other profit centers in real estate other than that net cash yield.
I think it's a mistake to not evaluate it because the reality is that your job as a rental property investor or an investor in general is to achieve the best risk-adjusted return on investment. And if you look at the 5 profit centers that we just talked through, the biggest impact on your overall return on investment, assuming that you are using conventional financing, the biggest impact will actually be home price appreciation,
right?
Assuming you are buying for a full market cycle. So to me, it just doesn't make sense to just put the blinders on and not look at it. We need to understand it. We need to understand when we can count on it. And then we need to use that as a part of the decision-making criteria.
What's interesting when it comes to appreciation and the fact that appreciation has now accelerated in the pandemic, which is something we didn't expect. If you remember the last time you were here early in the year, it was a very valid question. Will prices go down? No one really knew, but they didn't. And I think what's interesting, Greg, when it comes to appreciation and affording a property, we don't have time to do the calculations now. I might do that on a future show, but housing is actually less expensive now than it was in the 2006 peak when you factor in a couple things, inflation and low interest rates. What's so interesting when it comes to rate of appreciation and affordability and interest rates, almost no one buys a property based on the price of that property. People buy a property based on the monthly payment. If they're an owner occupant, they're looking at that in regard to their budget. And if they're interested in an investment property, which is like what we talk about, that has a substantial impact to your cash flow. People don't buy so much based on a price. They buy based on a payment. And that works so well right now just to transact, because if you want to sell a property and you have this appreciation, you can take the gain when you sell. But yet, if you want to buy a property, you don't have to pay substantially more for it due to those low interest rates.
Yeah, absolutely. I mean, when we speak to our clients, we talk about the deal being the debt right now.
Yeah.
The deal is the debt. The beautiful thing about rental property investing is that you don't have to try to find the deal to be successful in it, right? You can buy a property at market value. You can pay property management fees. You can earn a great rate of return, and you're going to be successful over the long run, assuming that you're with a team that can perform for you in a market that grows. But you don't always have this opportunity to go out there and secure this type of debt. Keith, I'm sure you would agree. I think this is temporary, right? The factors that went into achieving these ridiculously low interest rates don't happen more than every once in 100 years. We literally have never seen this type of financing or debt opportunity out there. And I believe more generational wealth is made an opportunity in an environment like today, where you know how to use the debt to your advantage than in other opportunities in real estate when pricing may have been lower.
That's right. You just want to transact. I actually don't have any purchases in escrow right now. I might have some soon, but you talk about the mortgage being the deal. I actually have a few mortgages in process because I'm refinancing a number of properties right now. But low interest rates are just one of the many reasons where here in the pandemic, housing has actually been a bright spot that might lead us out of this recession, where 12 years ago, housing helped us descend into the recession. And we really do need some bright spots here amid a medical crisis and business closures and unemployment. So talk to us some more about your remarks on home price appreciation, something that you have experienced in your market, including what your favorite source is for looking up home price appreciation rates.
I wanted to make sure I shared with all of your listeners just that how to evaluate home price appreciation. And the greatest thing is that the playbook is there for you. It's free. It's accessible. I'm happy to share where, I get some of this information so that you can do your due diligence. But I think one of the greatest mistakes by investors out there is, as I mentioned, they put these cash flow blinders on. And if they had known how to evaluate home price appreciation and they had seen what the historical data had presented, and they understood that real estate markets are cyclical, and that real estate home price appreciation rates tend to repeat themselves over market cycles, it's like you're having the answers to a test before you take it. What I wanted to share is how real estate appreciation works, how it tends to repeat itself, and then what you should be looking at to evaluate the best market for you to be investing in. And it goes beyond just low prices and high rents. It goes beyond the cash flow opportunity, because I don't want you or your listeners to look back after 10 years or 20 years of holding on to a property and miss out on a lot of gains. The biggest profit center when you look after a full market cycle, as I mentioned, will be home price appreciation. And we'll dive into that a little bit.
Do you have a favorite source for where you do your research on home price appreciation?
I encourage people to go straight to the Federal Housing Finance Agency website, which is www.fhfa.gov. That's the numbers. If we get into those today, that's where I'm referencing them from, and it's free and available.
Yeah, we're talking about the Federal Housing Finance Agency. They basically give oversight and regulation to Fannie Mae and Freddie Mac, whom are those government backstops for the loans that you get. That's what helps keep interest rates low. Lenders don't have to take as much risk when they have that government backstop, and therefore they don't have to raise rates and price in that risk. So that's FHFA's role. So FHFA.gov is a place you can check home price appreciation rates. Tell us more about those rates and how you use that.
Well, so I started to look into the different cash flow markets out there, and I wanted to see what their historical home price appreciation rates all the way since 1991. And when you're evaluating home price appreciation, you want to go back and look at a market's historically accurate home price appreciation. And what you will see is, if you understand what the historically accurate home price appreciation rate is, going all the way back to 1991 is 29 years of data. That's about as far back as the FHFA.gov site goes to get real consistent data. So that's why we chose that date. If you go back and you look there, you get this insight into what the market has done through multiple market cycles. And then if you actually look and break down 10-year segments, 15-year segments, 20-year segments in that individual market, one of the things you'll find is that the actual appreciation rate over those segments largely is very close to what the historical appreciation rate is. And what that means is that history repeats itself. It means in a market, if you understand what markets have historically appreciated more, what markets have historically appreciated less, and you are in for a full market cycle, then you can use this information to your advantage because you can choose a market that has appreciated more and make sure for at least for your buy and hold, your long-term full market cycle holds, that you're in a market that has experienced substantially more appreciation, because chances are you're going to experience that over the next 10 to 20 years.
And you might see home price appreciation rates that really aren't much greater or different than the rate of inflation. And you might wonder, what's the point? Is that even real appreciation? Well, it sure is when you're leveraged. If you've got a 5% appreciation rate and you're leveraged 4-to-1 with 25% equity, you take that 5% appreciation rate, multiply it by 4, and you have a 20% appreciation rate on your skin in the game. That's how real estate investors really get ahead. There are some times when investors should not be thinking about appreciation. Actually, Greg's going to tell us more about that when we come back. You're listening to Get Rich Education. Our guest is JWB's Greg Cohen. I'm your host, Keith Weinhold. Congress just made it possible to get up to $100,000 out of your current 401k or TSP to invest in real estate, gold, or even your own business. That's even if you're still working, and avoid the IRA UBIT tax. The thing is, you can get your money tax and penalty free for a limited time. The EQRP is your secret weapon. With the CARES Act expiring soon, the EQRP company helps you unleash your retirement funds now. Learn more and text message EQRP in all capital letters to 72,000. Most rental property investors choose either positive cash flow or home price appreciation, but one real estate market can provide both: Jacksonville, Florida. With 9% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets since 1991. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com.
This is author Jim Rickards. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Greg Cohen, really focusing on the appreciation, that one of 5 components where you're often simultaneously paid as a real estate investor. Greg, talk to us about that in real dollar terms when it comes to appreciation. Let's break down some numbers.
Keith, you mentioned that the percentages of appreciation might not be that big from one to the other, from one market to the other, if you're looking at the actual percentage. But that doesn't mean it's really not meaningful. What I wanted to do is actually break down the difference between a lower performing appreciation market and a higher performing appreciation market over the long haul. So I chose Cleveland. I'm a Pittsburgh Steelers fan. My team is undefeated right now, so I chose Cleveland to beat up a little bit on. Is that okay?
I thought you might, because the Steelers and the Browns do have that rivalry, if you can call it a rivalry. I mean, if you look at the Pittsburgh Steelers and Cleveland Browns rivalry over the past decade, that rivalry is like the rivalry between a hammer and a nail, the Steelers being the hammer and the Browns being the nail, probably. But anyway, it's interesting that you do want to pick on Cleveland, being the Steelers fan.
Your analogy is so great. That's why great minds think alike, Keith. So I looked up the appreciation rates historically from 1991. Cleveland's historical home price appreciation rate, according to FHFA.gov, is 2.3% per year on average. Since 1991, it's appreciated 2.3% per year on average. Jacksonville, on the other end, is at 4.3% per year on average, which is known as a growth market, which is higher than the historical national average there. You look at 2.3%, 4.3%, you're like, well, what does that really mean? It's somewhere around 3%. What is that really impacting me? Well, what gets lost here is the length of time. We're assuming that you're investing for a full market cycle. What gets lost here is the length of time and the fact that you're investing in assets that are $100,000 or $200,000, right? The effects of investing in the market that you choose when you combine a lot of time and a high dollar value are immense. Here's the numbers. If you bought a property for $100,000 in 1991 in Cleveland, according to the historically accurate appreciation rate of 2.3%, it would be worth $195,000 in the year 2020, which is pretty cool because it's nice to see that real estate grows over time. It's nice to see that appreciation that we're talking about. And obviously I'm going to be picking on Cleveland a little bit. So I just think it's a win for real estate in general to show that, geez, there's $95,000 of equity buildup, of appreciation.
Even if your city has a losing football team, there's still been some equity buildup in your home.
There you go. Even if your population is going elsewhere, right? Now, Jacksonville, on the other hand, if you took that same $100,000 in 1991 and you invested that in Jacksonville, according to that 4.3% appreciation year over year, it would be worth $339,000 for that one property. That's $144,000 of additional return on investment from that seemingly small difference of 2.3% versus 4.3% on one property.
Because there is a compounding there. $339K in Jacksonville over about 3 decades versus $195K in Cleveland.
Exactly. And if you're thinking about this as far as building a portfolio, as many of your listeners and our mutual clients do, in 3 properties, 5 properties, 10 properties, we are literally looking at the right market to invest in as being $1 million decision for your future wealth. The thing that just cracks me up that I just can't get a grip on is why people say, well, I'm not going to pay attention to home price appreciation. I'm going to invest forever. I'm never going to sell my rental property, but I'm not going to I'm not going to look at home price appreciation. This example right here is one reason showing why you got to look at it if you want to make the best return on your investment.
Yeah, if you have a short-term mentality like a flipper or a wholesaler or something else, then not factoring in home price appreciation might make some sense. But yeah, if you're looking at something decades long, which is what we focus on here, long-term buy and hold real estate investing, it totally makes sense to look at appreciation that way.
Absolutely. I mean, and you bring up a good point about the timeline. If flippers, wholesalers, those who hold rental properties for shorter terms, this message doesn't necessarily apply. This is targeted to those buy and hold investors that plan to hold on for a full market cycle, because just as I showed that history repeats itself over the long haul and over full market cycles, it doesn't necessarily appreciate it at the same rate over 3-year periods or even 5-year periods. If you are a buy and hold investor, but your hold horizon is 1 year, 3 years, maybe even 5 years, I don't think you can count on home price appreciation. It's just too speculative at that point. If you are of that buy and hold mentality and you know that you're going to be holding on for a long time, it behooves you to look into it.
And when one is holding on for a long time, oftentimes we might think of that residual income stream from the tenant as kind of that threshold that allows us to control that mortgage long-term and get us in the door.
Yeah, absolutely. And this conversation of appreciation is something I'm very passionate about because I feel like it is misunderstood. But the reality is the reason to invest in rental properties, the thing that separates it from all the other asset classes, starts with the fact that it pays you positive cash flow every single month. So we've got to make sure that we stay true to the first threshold, which is we've got to invest in assets and markets that pay for themselves every single month. That's what our good friend Robert Kiyosaki, through Rich Dad, Poor Dad, the book that changed my life and many other lives, taught me. It's the power of an asset versus a liability. We want to be investing in assets and markets that pay for themselves. But once you get there, what most investors do is they stop. They only look for the market that gets the highest return from the net income, from the cash flow. What I offer to other investors out there and what I teach to our clients is that's the first threshold. Now we got to do a little more digging. Now we have to go and find, out of that small handful of markets out there, which has historically performed at a higher appreciation rate, because you can get the best of both worlds. You can get positive cash flow and an above average home price appreciation rate.
Well, you deal with a lot of investors there at your company. In fact, you are one of the earliest turnkey companies in the United States to offer new construction products because you had that foresight to buy up land back during the Great Recession and make that work for you. When you do advise so many people that come in and are looking to put some rental property in their portfolio through your company, what do you typically tell them? Just what do you suggest is the right way they choose a market to invest in rental property? Start about thinking with cash flow first and then look around for what might appreciate best, or start with appreciation, or what do you like to tell them?
You start with the most important thing. The most important thing is that you need to be investing in positive cash flow first. And so the way that you can identify the right market for yourself is to identify those markets that have positive cash flow, right? The easy way to do this, again, I go to Federal Housing Finance Agency for the home price appreciation part. The cash flow part, all that information is really available to you as well for free, generally. If you want to understand which markets are going to achieve positive cash flow, you need to have low prices and high rents in a market. So what I would encourage you to do if you want to find those cash flow markets, find out what your median home price is in your market and compare it to the national median price. If your market has lower prices than the national median, that's a really good start. That's going to eliminate markets like California, New York, Virginia, some of those high price markets out there. The next step for you is to go and find out what rents are doing. So we know we found markets that have low prices. Now, on the rent side, the U.S. Census tells you what your median gross rents are in a market. So you can go and look up your market's median gross rents, and you can compare that to the U.S. median. And if your gross rents are above the national median, then that's a really good sign. Now you've identified a handful of cash flow markets out there. But I don't want you to stop there. That's where most investors stop. The next step, again, is to go to a place like FHFA.gov and do the research to find which markets historically appreciate more. And when you do this, you'll find markets that over time have appreciated more or less. The best market for you where I invest, of course, I'm jaded because I invest in Jacksonville and have since 2006. The reason I love Jacksonville the most is because it has the best combination of low prices, high rents, and over time, Jacksonville has appreciated 34% more than comparable cash flow markets across the country. And I'm looking for the best risk-adjusted return on investment over the long haul, and that's what Jacksonville gets me.
Jacksonville, Florida is one of those very few geographic coastal markets where the numbers make sense, where you do get that high ratio of rent income to purchase price. And not only have I been in JWB's offices, I've been in the rental communities, I've been inside their product myself. So tell us more about how one would get started if they're more interested in looking to add rental property to their portfolio in Jacksonville and just what you offer with the new construction.
Keith, thank you. So I would encourage everybody to go to cashflowandgrowth.com, cashflowandgrowth.com. There you can view our properties, our new construction properties. We also have renovated homes. And one of the best things about investing with us is that we believe that the greatest correlation to your success is how long your resident is going to stay in your home. How long is your resident going to stay is incredibly important. So one of the things that we focus on are long-term leases with our residents. For our properties, they all have 2 or 3 year leases. And I found that in my own rental property investing and of course, helping other clients around the country and knowing other property management companies, it is incredibly important to make sure that goals are aligned between property management companies to achieve your success. And it's hard to find a property management company that's going to sign long-term leases because they end up sacrificing a lot of short-term profits by doing that. But you've got to find a property management company where that aligns, and those 2 and 3 year leases really help you in the long run make sure that we can accomplish your positive cash flow goals.
If you as an investor have a long-term mentality and you're working with a company where they get 2 to 3 year leases and you have a new construction product, you can just think about how much you can sit back and relax, and you're probably not going to be hearing very much from your property management company other than getting that monthly rental statement, which you probably look forward to. Go ahead and check out cashflowandgrowth.com.
Keith, always a pleasure. Thank you so much for having me on your show.
Oh, it's been so good having you here. Of course, you might also like the Freddie Mac Housing Price Index. I tend to favor this and the FHFA index that Greg talked about over the Case-Shiller 10 and 20. Those 10 and 20 markets are a majority of non-cash flow market areas. Now, Jacksonville, Florida is just huge in terms of the geographic area. In fact, it is about 750 square miles, which would be then like 30 by 25 miles to give you some idea. And in those terms, it is indeed the largest city in the contiguous United States. So if you like this suburban trend, understand that a home can still have a Jacksonville address and yet be somewhat distant from the urban core. And I like how Greg looks at appreciation and talks about how the deal is the debt. Again, it's the mortgage and the lease that turn real estate from a liability into an asset. And the standard 2 and 3 year leases that JWB does are a great way to help anchor that real estate as a long-term asset for you. And what they offer there are detached single-family homes and townhomes. They don't have any multis. And for prices, they range from $150K to $210K. And the renovated home prices are generally at the bottom half of that range. And then the new construction ones are at the higher end. You get about $1,100 of rent on a $150K property. Then you get about $1,300 rent on a $180K property. And something like $1,425 for a $210K purchase price. They are numbers that are aided in this mega low interest rate environment, and they make the experience turnkey for you. The property is either renovated or brand new, and if you like, they both place the tenant and hold it under management for you. Get started at cashflowandgrowth.com, and that website address is spot on because it's cash flow first, and then you're looking for that long-term growth. He and his company bought up land when it was cheap, coming out of the Great Recession. That's how they might be able to pass that advantage on to you. A lot of times you'll see them offer infill new construction property, that is new construction with a mature neighborhood around it. Hey, big thanks to Greg Cohen, who's really become a rock, a community contributor, and a quality fixture there in Jacksonville over the long term. If you're looking for a long-term relationship in a fast-growing metro, get started at cashflowandgrowth.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.